Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that all of you are staying safe and healthy at this time. We have several important topics to cover today. We have Melissa Labonte joining us to bring timely updates related to the DC stimulus scene. Welcome, Melissa.
Thank you, Leslie. Happy to be here.
We also have Brian Duran with us to discuss how you can create opportunities with the opportunity zones. No pun intended. Brian, we're glad to have you.
Thanks, Leslie, and absolutely pun intended with opportunity zones.
And we have Christine DeMena providing important PPP updates. So welcome, Christine.
Thanks, Leslie.
So before we dive in today, we do have some housekeeping that I want to cover. We have the ability for live Q&A during the session today. In order to participate, you must register and log in using the link below me. The questions are going to appear for you in the audience, and you can like those to move those up into priority so that we can address them. We also have moderators that are standing by ready to engage and interact with you. We also want to let you know of a couple special events we have coming up. We have a webinar scheduled on February 17th called A Survival Guide for Nonprofit Finance Teams. Additionally, on March 2nd, we have an event for financial institutions on problem loan management. So you can register for these events on our website. Now, in addition to these great events, be on the lookout for articles and other white papers providing guidance. And as always, please contact your CLA relationship because we absolutely want to talk to you. So with that, let's start with Melissa. Melissa, we are starting to see a ton of discussions related to stimulus and policy that are swirling around. And so last week, Congress passed budget resolution related to fiscal year 2021. So what are next steps related to this budget reconciliation, and when do you might think that we might actually see some new law here?
Yes, Leslie, Congress passed the budget resolution last week with instructions for the different committees, I think there's like 12 in the House, to write proposals that fall under their jurisdiction. Okay, that's in the process of happening right now. There are draft bills, they're having markups, they're very busy. Next is the proposals are going to get combined into one package by the budget committee, and then the House is expected to take up that package probably the last week of February. Okay, so that version, assuming it gets passed, would go over to the Senate and they would look at it, and if they have any changes, the two chambers are going to have to reconcile any differences. So we're expecting something probably the first or second week of March. That's because March 14th, that's their deadline or target date. That's when the enhanced unemployment benefits are set to expire, and the Democrats want to get a relief package out before then.
So that's really helpful to understand that time frame. And so let's start to talk about what are some of those things that we might see in that package. We've been talking a lot about various employer and employment tax credits, and we do understand that there's some talk of those being in there again. Let's talk about what we might see extended related to some of those credits.
Yes, Leslie, President Biden wants that emergency paid leave that we had last year, and it actually expired on December 31st. He wants to put that back into place, and he wants to eliminate the exception that we had for employers that had less than 50 employees. Now, along those same lines, to pay for the cost, those payroll credits for sick and family leave, those would be extended 6 months from March 31st until the end of September. Now, along those same lines, the popular employee retention tax credit would also be extended 6 months. That right now, that benefit goes through the end of June. It would then be available through all of 2021. So this is the plan, Leslie, but things, especially legislation, don't always work out the way they planned. And we are still very, very early in this process. So this is all possible that could all change.
Yep. Always good to understand this is basically in the negotiation phases. So let's just stay with what's the blueprints of this plan look like as things are starting to come together. We also know there's some discussions related to maybe grants and direct payments. The EIDL was a big part of that, which were direct payments related to some disaster relief that happened with the CARES Act. Those ran out very quickly when we were dealing with the CARES Act. So tell us, what is the latest on these EIDL grants, and do you think that we will have some additional allocations for that program as well?
You are exactly right, Leslie. There were 2 opportunities last year for the EIDL grants. As you mentioned, the CARES Act had those emergency EIDL grants that were up to $10,000. And as you mentioned, that money ran out very, very quickly, right? There were a lot of eligible businesses that only got a smaller amount or perhaps didn't get anything at all. So what Congress did is they allocated more funds, and that came out in that year-end package for what they called targeted EIDL grants. So if you sent in your application earlier in the year and you didn't get that full $10,000, you don't have to go and reapply. They would reach out to you. But there were some more restrictions, right? And fewer businesses qualified. First, you had to have either 300 employees or less. You had to have a loss greater than 30%. And you had to be what they refer to as a low-income community, okay? So now that they're going through that process, they're thinking that's still not going to be enough funds for those hardest hit businesses. So the draft legislation right now that's being considered in the Small Business Committee is as part of this reconciliation process. They're wanting to allocate another $15 billion to these EIDL grants. That money would first go to those businesses that maybe still didn't get enough of that $10,000 last year. But, and I think that's like the first 2 weeks perhaps, if there's money left over, you can go back and get an extra $5,000 if you're considered one of those severely impacted businesses. So you still have to be in a low-income community, but your loss or your reduction in revenue has to exceed 50%, and you have to employ not more than 10 employees. Now, those applications, if this gets enacted, you're going to want to get your application in as soon as possible because it's first come, first serve, right? If you don't get it in soon enough, you might not be eligible for that $5,000.
Yeah, so that's all really helpful, and certainly 5,000, 10,000 can go a long way to those targeted communities. So what about though businesses that aren't in low-income communities or maybe that are ineligible for these EIDL grants? Are they eligible for anything else, maybe another round of PPP? What are we seeing for them?
Well, President Biden, instead of investing in that PPP program we all got to know very well last year, he would rather invest in state and local programs, right? Programs that invest in small businesses, whether it's through lending or investments. He wants to allocate another $35 billion to them, right? The idea is for these struggling business owners not to get a grant unless they qualify for the EIDL grant, but instead to get a low interest rate loan. Unfortunately, there is no mention of any type of a forgiveness piece, at least not for now. They would also allocate another $7 billion to the PPP, but it's not for another round of financing. Instead, it's to expand it to more nonprofit organizations that were not initially eligible for those PPP funds. So overall, it's going to be a very interesting and very busy time in DC over the next few weeks here.
Yeah, so we really appreciate those insights. As you said, even though this is just the initial blueprint, we do expect that this is going to evolve as people negotiate. So we're going to keep you around for some questions as they arise. And now let's pivot over to Brian Duran. We're going to discuss current developments around opportunity zones and really how these can benefit businesses and their owners, because we are knee deep in tax planning season, and this is just an amazing opportunity, both from a tax planning and a wealth advisory perspective, that we can really marry up if we're thoughtful. So, Brian, Melissa just talked about legislative activity with the new administration. I think it would be great to just start with what direction the new administration is heading when we think about OZ legislation.
Thanks, Leslie. Well, we are hearing that this program continues to have strong bipartisan support, which is very important for its ongoing success and impact in local communities. We also are hearing that the president's administration does not want to repeal, but rather reform opportunity zones so that they can be as impactful as they were originally designed. One of the common themes that we are seeing a lot of talk about is for additional transparency and reporting around OZ activities and results. This program, it was a self-certification process for entities to take advantage of the tax incentive. And so these additional reporting and transparency layers are going to be aimed potentially not only at the quantitative factors, but also qualitative factors such as socioeconomic characteristics of the specific tracks that they are investing in. Another very key possible provision that we're hearing about is the potential for some OZ tracks to be phased out. It may not be a surprise when you look at the map that some of those tracks are in areas that may not be considered highest need. They may be considered to have higher than the designated poverty income statistics. So the administration may consider phasing out some of those OZ tracks from future incentive. We feel like it's going to be really important for there to be grandfather provisions in any new legislation to protect any investments that have been made in those tracks for the duration of the OZ program's life. We're also hearing that there may be some relaxation around the pre-existing rules for entities that were not formed after the OZ legislation, or for certain assets that were not acquired after the legislation, because there's a lot of companies and assets that are presently in an opportunity zone but have a very narrow window of actually applying and utilizing the benefits.
Yeah, so I think that's all really helpful, because certainly what I'm hearing from you is that the direction is, yes, let's keep supporting these. It just maybe let's reform these to the intention and let's moderate the rules some. So staying with that, what should taxpayers do if they receive an IRS notice related to their prior opportunity zone filings? I know sometimes people can get an IRS notice and it just causes them to panic, but let's talk about what could that really mean.
Well, first of all, you should not ignore it. Taxpayers that receive these notices from the IRS should talk to their tax advisor and determine the best way to respond. We're finding that these notices are really nothing more than, in most cases, nothing more than requests for additional information. Given the time frames that taxpayers had in order to make a qualifying investment, a lot of times the information that they reported on their return, where they deferred the capital gain, was in a different tax year than the investment into which they made. So we potentially have just simple matching issues with the IRS, where if they invested in a new entity that was newly formed, the IRS doesn't have a tax return on file yet. And due to the self-certification process, that entity has not had the opportunity to establish itself as a QOZ fund. And so we feel like a lot of these notices are really just a matter of timing, and for the IRS to really connect the taxpayers that made the investments with the entities that received the investments. And certainly with the lengthening of the ability to make investments in 2020 due to the pandemic relief, taxpayers are able to make investments over a longer period of time, and that certainly has probably compounded the IRS ability to successfully match up investors with the investment funds.
Yeah, so good advice. Contact your advisor and work through that. All right, so now when we start to think about strategy related to opportunity zones, what should a business entity be aware of when they're establishing operations in an opportunity zone?
That's a great question. And over the life of the program so far, we saw a strong attraction for real estate related investments in opportunity zones. Based on the geography specific nature of the census tracts, real estate investments were probably a very common one to become invested right away. But we're seeing a lot of opportunities arise now. Again, there's that pun, Leslie, but for businesses, operating businesses, to take advantage of the program benefits as well. And the administration of the qualifications for an operating business may pose to have certain different challenges than a real estate business, where a real estate business, the bricks and mortar are in the zone, those tangible assets are in the zone, so there's really no question of their qualification. The rental revenue is earned directly within the zone. So again, all of that revenue is directly benefiting that zone. But think about a business that might operate out of a zone centrally, but serve customers across all different lines, maybe outside of the zone itself, or even outside of state lines. We certainly are seeing the e-commerce activity over the last year definitely take a new trajectory. So an operating business that is centered within a zone can definitely take advantage of the program, but they have to be very careful that they meet all the required tests, not only for the tangible assets, but also the revenue sourcing.
Yeah, so those are, go ahead. I think you had something else to say.
I was going to say another important piece that operating businesses will want to be aware of is this reliance on the working capital safe harbor. The working capital safe harbor is meant to allow entities that have been capitalized with a higher degree of liquid funds that have not yet deployed those funds to come up with a plan or a strategy to utilize them within a required time period. So an operating business will definitely want to make careful consideration of utilizing a working capital safe harbor for any additional excess liquidity as a result from the capitalization.
Yeah, so it does really truly sound like a wonderful opportunity, especially as you think about just the expanded deadlines that we have to make these investments. So we're going to keep you around for questions that come through at the end and certainly bring you back in to answer those. So thank you for that update. Now we're going to pivot over to Christine and have her talk about just some current questions and developments that we have been seeing from our clients and our viewers related to the PPP. So welcome back, Christine. Christine, we'll start with the fact that we know there's been some confusion concerning unresolved issues for first draw PPP loans, particularly in situations where we've got borrowers that have submitted for their forgiveness applications for their first draw loan, and they're also trying to apply for a second draw loan. So can you maybe give us some background on those situations?
Absolutely. So in general, borrowers with first draw loans under review and with unresolved issues will not receive their second draw loan until those issues are resolved. So if you remember back on January 26th, the SBA provided some clarification on this through the release of a procedural notice. And this notice addressed the SBA's procedure for unresolved issues on a borrower's first draw PPP loan. This notice has now been subsequently revised with a new procedural notice that was just issued yesterday. On January 27th, the SBA began processing second draw PPP loan guarantees for borrowers with unresolved issues, and they moved those forgiveness applications to a research status. And this allows the lender to go back and submit additional documentation to try to resolve whatever those issues were with their first draw loan applications. So the SBA should be providing information and guidance on what additional documentation is needed in those cases. Now, the procedural notice that was released yesterday gives some really great examples on some of the various hold codes and also walks through examples of what type of support they're looking for each particular hold code.
Yeah, so that's just, I think, really helpful to understand that. So what should a borrower do if they've got an unresolved issue with their first draw PPP loan?
Yeah, so the borrower should really get that additional documentation back to their lender as soon as possible. And if they are unsure what to provide, contact the lender. And if they feel that they already provided the information that they're being asked for, they should talk through that with their lender as well to make sure that whatever that information that was provided is easily identifiable by the SBA and clearly marked. An unresolved issue doesn't prohibit a borrower from receiving a second draw loan, but it could affect the timing on when that funding is done if it's not resolved. So that's why it's important to get that documentation in as quickly as you can. And then the lenders will need to work with the borrowers to assess the situation and then supply that additional information if they're confident it will resolve the issue. And then once that has been resolved, the SBA should move that second draw application out of research status and put it through to the next process.
So I think understanding that is all really helpful, and just understanding the timing of all of that. Let's now pivot our discussion to talking about another really hot topic, and that is the interplay of the PPP and the retention credit. So there continues to be a ton of questions just about the interplay of those two and just how we optimize that. So what should organizations be considering as they think about how those two items can work in tandem with one another?
Yeah, this certainly is a hot topic, and we've been fielding many questions about the interplay between the PPP and the ERC. And in particular, questions for organizations that are trying to strategize, should they apply for a second draw PPP loan and or apply for the 2021 employer retention credit? So since you have the opportunity to have the PPP funds fully forgiven, that really gives you a dollar for dollar benefit with those PPP funds. And also, they're not taxable. So in many cases, organizations may want to consider applying funds first towards the PPP and then taking that excess payroll that they're not using for PPP and using that for the ERC if they qualify. So as a reminder, you can use up to 40% of your PPP for non-payroll related eligible costs. So this could leave some payroll funds on the table to apply to the ERC. The 2021 ERC gives you a 70% credit on the dollar. So again, that's where it may make sense to try to use funds for the PPP first. But the most important consideration is to remember that you cannot double dip. You can't use the same payroll dollars for both the PPP and the ERC. And I've had some interesting discussions. In particular, some organizations are considering not even applying for that second draw PPP, even though they're eligible, and just taking the ERC for 2021. And the reasoning there is that the ERC it's easy to file for that. It's just on your 941s. It's easy to claim. And it doesn't have the same level of calculations or process as you have to go through with PPP forgiveness. And it also doesn't have that economic need certification part. So some companies that technically are qualifying for a second draw PPP, but maybe aren't feeling comfortable with that certification, may also lean just towards claiming the ERC for 2021. If
yeah,
an organization,
amazing.
Sorry.
There's so much strategy there when I'm hearing you talk about this and things to think about.
Absolutely. And it's a little different if they're newly eligible for the 2020 employee retention credit and they have not filed for forgiveness yet. That's where they really have the opportunity to do some strategic planning using the whole 24-week covered period and trying to utilize that 40% of non-payroll costs.
Yeah, so when I hear you talk about all that strategy, I mean, you talk about, possibly allocating costs, you talk about deciding which one's best for you, you talk about economic necessity on those first one. It really sounds like if you're weighing that, it might be helpful to contact an advisor and really walk through all the options, walk through the value of these credits dollar for dollar compared to the PPP. Let's also talk about the situation that many companies, I think, might be in, or organizations for that matter, and that is that they've filed for forgiveness on their first draw loan, and now they realize, because the law changed, that they want to go back and claim the retention credit. What do?
Yeah, so this is definitely an issue as well, and there's a few different scenarios really to consider. Payroll that you used for the PPP, if you've already filed, that should be clearly identifiable. So by check date and by employee what funds you took for payroll and applied to the PPP. So it should be fairly easy to first carve out what are the remaining payroll dollars that were not used for PPP from March 13th to the end of the calendar year. And did any of those funds fall in the quarters where you may be eligible for the ERC? As you said, many organizations chose to just include payroll in those PPP calculations because it was easier. So let's go through an example. A PPP loan was $1 million, and the total payroll cost for the 24-week covered period was $2 million. And there was no reduction in FTEs. So in theory, only $1 million of that $2 million was used for the PPP, and the rest could be up for grabs. I just think you have to be very careful in these cases. So in the same scenario, that loan is $1 million. Eligible payroll included was $2 million, but you had a 50% reduction in FTE during the covered period. So in order to get full forgiveness of that $1 million, you needed all $2 million of those payroll costs to absorb that reduction. So I think it'd be hard to argue there that that remaining $1 million would be up to grab, up to apply elsewhere because you did need it in the PPP. So those are some of the things I think you need to think about if you're strategizing that way, and just be very clear to document and delineate between payroll used for the PPP and the payroll used for the ERC.
Yeah, that's a great example because that was a very sneaky and subtle example, and I think one that could sneak up on many people. So I'm really glad that you walked us through that and clarified that. We are going to take a couple questions from our viewers. I want to start with a PPP question, and so this one is for those who did not previously qualify for PPP round 1, but do qualify under the updated guidelines. How long after forgiveness for PPP round 1 do they have to wait to apply for round 2? So I'm thinking now, they didn't do the first round, but they want to try to go after round 1 and round 2. Do we know if there's an approach and thought process to this, knowing that there's that March 31st deadline out there?
Yeah, so it's going to be a very tight timeline for that, but basically you need to have used your round 1 funds before you can start your covered period for round 2. So if you can somehow time it and take the minimum 8-week covered period, say you got your loan for PPP round 1 on January 31st, or it might have to be even sooner, say January 20th, and you go out 8 weeks and then you get dispersed your second draw after that 8-week period, that's how you could potentially make that work. But it is a very, very tight timeline, certainly, if you're trying to go after both rounds right now with that March 31st deadline.
Well, that's a really just good overview of that. We do have another question related to the opportunity zones. And so, Brian, I want to direct this to you. There has been changes, and we've talked about this on prior live streams, related to expansion of the time frame that we have to be able to take advantage of deferral. And it may mean amending tax returns, which is a really interesting, I don't want to say opportunity again with the opportunity zones, but it is a really interesting opportunity that we have to possibly make some late options to defer that. So can you walk us through how we might do that with even a 2019 gain right now and the time frame that we have to make that election?
Absolutely. And this strategy is definitely now available again. In 2020, the IRS released an IRS notice that extended deadlines to make an election through the end of the calendar year. Last month, the IRS issued another notice, 2021-10, which further extended that relief guidance to end now on March 31st, 2021. And it kept the same parameters as the original relief guidance. It just extended the end date. And so what this means is if a taxpayer had any 180-day period that was scheduled to end on or after April 1st, 2020, they now have until March 31st, 2021 to make an eligible investment in a qualified opportunity fund. And so if you think about when 180 days would have had to start to end on April 1st, you do start to capture some of the potential gains that were recognized, would have been recognized in 2019. So as we stand here in February of 2021, we can still advise on amending tax returns for 2019 and claiming a deferral election for an investment made up till March 31st. I have admittedly been receiving some questions on some of the confusion that this latest notice has caused with respect to 2020 gains. And so the important thing is to remember is that any 2020 gain that does not have its 180-day period that ends before March 31st follows the regular rules. So for example, the most common elements might be a gain that you or a taxpayer would recognize on a K-1 for calendar year 2020. That gain is going to be considered recognized on December 31st. And so therefore, the 180-day period starts on December 31st and ends roughly June 30th of 2021. So the relief guidance does not really affect that type of taxpayer. So I think the important thing to remember is that the relief extends the opportunity to make an investment for any gain that otherwise would have timed out its 180-day period before March 31st. If you have fresh gains that are that were realized later in the year or on December 31st, in the case of a pass-through entity K-1, follow the regular rules for the 180-day period.
Yeah, so definitely you need to talk to your advisor because there's going to be a limited subset of 19 and 20 gains that this applies to, but nonetheless, sounds like an opportunity to me with opportunity zones. So I think that's fantastic. All right, we do have another PPP question that I want to ask, and this is for you, Christine. So can a person who has a Schedule C and a Schedule F income apply for a PPP under both a Schedule C and a Schedule F? They both have, so the Schedule C has a separate EIN name and the Schedule F runs through the personal ID number.
So in theory, yes, but you have to remember that each person has a cap. So that individual would be capped at that $20,833 regardless. But I would say they should consider using the Schedule F if they can receive the maximum loan that way. Otherwise, you'll have to file 2 forgiveness applications if you try to split it between the 2.
Awesome. Well, unfortunately, that is all the time that we have for today. I want to thank all of our speakers, our moderators who have been live with us, and all of you for your engagement and your questions. I want to encourage everybody to continue to register and engage with us. We love having you be part of the conversation with us, and we will see you all next week. Until then, please continue to be safe and healthy and have a wonderful day. Thank you.
Thank you.